Hello and welcome to our latest Insider interview. Today in the studio I have with me Glennie, who is co-fund manager of the Aberdeen UK Smaller Companies Growth Trust. Abby, thanks for coming in today.
Thanks for having me.
At the time of this recording, the conflict in the Middle East is ongoing. How, as a fund manager, do you approach what is unfolding and the pickup in stock market volatility that we've seen?
So I think firstly, it's very sad to see the conflict that's evolving and the people who are caught up in that. As fund managers, I think that we have to be cautious of this in that the market is being very short-term focused at the moment, but that these things can turn quite quickly. So you don't want to be too drawn into that. I think we went actually into this crisis with quite a lot of balance in the portfolio, and we've been using risk tools to help do that. So I actually think we were quite well positioned for that even before this kicked off. And we continue to look at quality always as part of our investment process. And in times of difficulty and volatility, that tends to stand up quite well. We are looking at areas of opportunity as well, though. So, for instance, we've been continuing to build up our newer holding, which is Plus 500, which is an online trading platform, and that tends to do well in times of market volatility.
Interest rate cuts could aid a further recovery for UK smaller companies. How much of a problem for the portfolio is the prospect of rate pauses or even rate hikes following the conflict in the Middle East?
So you're right, decreasing interest rates tend to be a real catalyst for smaller companies and for flows into that space. And as we sit here today, actually, I think the probability of a March cut has really gone away. But most strategists, economists are still thinking that we probably get 2 interest rate cuts in the UK this year. But it does feel like the risk has increased on that not happening. I think the thing that we should sort of remind ourselves, though, is that if we look at 2024, 2025, actually this asset class delivered, quite strong returns in a higher interest rate environment. So while we view cuts as being positive, we don't think that's the only driver of returns.
With an energy shock and the possibility of higher interest rates, what's your current stance on the UK consumer? How heavily is the investment trust focused on the consumer and the UK economy?
Yeah, so I think sort of stagflation is definitely one of the things that fund managers need to consider as an outlook now. The portfolio actually has very little exposure to UK consumer. I think we've been reasonably cautious on that for a while because even though a lot of the stats have been quite supportive of consumer and of savings rate and employment, actually the sentiment has been quite tough, whether that's been media driven or really about true household income. I think there's actually been quite a few inputs into that. So where we do have consumer exposure, we really try to pick the sort of what we think are the best leaders in categories and where they have many levers to operationally drive their business. So for instance, things like Dunelm in retail, Wix we also have a bit of exposure to, and Jet2 in travel, and that's definitely been the tougher one lately.
UK smaller companies are offering a higher yield than UK larger companies, and that's the first time that's happened in over 20 years. So firstly, why has that happened?
Well, so I guess one of the challenges of that is it's been driven by returns. So, the yield becomes a somewhat calculation. So the underperformance of small cap is part of that. I think the other thing, though, is the real capital discipline that we see in businesses, and particularly the increase in that through smaller companies. So we're now seeing more and more smaller companies make sure that they actually are returning to shareholders. And so we're seeing, higher dividend payments, but also particularly share buybacks. We've seen a real turn to share buybacks in the market.
And secondly, how, as a growth-focused investor, are you approaching this particular trend? Is there a potential downside to this trend that companies are over-prioritizing dividends and share buybacks at the expense of growth?
So I think in terms of portfolio companies that we're investing in, absolutely, we have a lot of companies now who are doing share buybacks. And that's really, they're showing the market actually the value that they see in their own business. And so therefore, looking at the valuation of their own company and saying, this is a great investment return for me. I think longer term, if we see companies continue to just return all of their capital and not be doing proactive growth investing, I think that is a concern. But what I think we'll see is that actually, as markets evolve, we'll see companies get more of that confidence to then go and invest, whether it be organically or inorganically through acquisitions. The other thing is, the valuation of a company somewhat is their currency to do deals quite often. So, I think as we can see valuations improve, that allows companies actually to be more proactive about deals. And if we see, some interest rate cuts, that also makes debt funding a bit cheaper. So, those things will all help the accretion of deals and help companies to probably be more positive about doing that.
The investment trust has a yield of 2.7%. So how much of a focus is dividends for the investment trust?
Yeah, so look, we aren't an income trust, but the board are very aware of how important dividends are to many of our shareholders. And, it doesn't constrain us as managers at all. So, we're pleased to pay out an attractive yield. What we'd really love, though, is that we'd love to see the dividend yield shrink if that was driven by share price return.
I next wanted to ask you about gearing levels. So the latest figures that I can see, which are to the end of January, shows the gearing percentage at around 12%. That's nearly double what its level was last summer. But how are you now approaching gearing, particularly in light of the conflict in the Middle East?
Yeah, so we believe in having long-term structural gearing in the portfolio. It's one of the great benefits of an investment trust is that if you believe markets are rising over the long term, you can more than benefit from that. We have, though, been reducing the gearing somewhat. So, very conscious about short-term market headwinds.
And finally, Abby, a question we ask all fund managers that we interview. Do you have skin in the game?
Yeah, absolutely. So Amanda and myself both have significant holdings in the investment trust.
Abby, thanks for your time today.
Thank you.
So that's it for our latest Insider interview. Hope you've enjoyed it. For more videos in the series, do hit the subscribe button and I'll hopefully see you again next time.